Welcome, everyone, to the latest edition of Macro Matters, where we cover all of the macro that matters. My name is Rich Excell, CFA charter holder, member of the CFA Society of Chicago. And as always, I am joined by my co-host, Tony Zhang. Tony, welcome.
Hi, Rich. Definitely, we just finished the last semester and this getting into the summer. But before the summer kick in, and apparently we did not see the selling May go away, which we
Yeah.
anticipate to see it. But still, a lot of exciting news like just happening over the past few days, and a lot of exciting news will happen maybe even tomorrow. So I think I'm really looking forward to discussing with you.
Yeah, you're absolutely right that we talked about that a couple weeks ago in the sell in May potentially, and some of the negative things that we're seeing, and there's still some negative things that are going on out there, but I think what's probably caught a lot of people by surprise, perhaps maybe not, is the amount of liquidity. I mean, we've talked about financial conditions being pretty easy, and I
Mm.
think that is certainly what we're kind of seeing that's driving a lot of asset prices right now. But I think there's also some stories that are going on still, right? You mentioned like here we are on May 21st recording this. We're going to get NVDA earnings tomorrow night. NVIDIA earnings have become basically as important as non-farm payrolls and other sorts of economic data points in terms of setting the tone for the markets.
Certainly.
And we can look at that really quickly. But also, as we were talking before we started, cryptos back in the news. And I
Hmm.
think cryptos in the news for a couple of reasons. One, I think it's probably the 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 thing that responds most rapidly to increases and decreases in liquidity. And so when it's moving higher, especially Bitcoin, it tells me that there's a lot of liquidity still sloshing around. But yesterday we got some rumors, if you will, on the possibility of an Ethereum ETF. And so, I'm going to share my screen, Tony. I was looking through some different Bloomberg pages, and for those that are on the podcast, I'll try to describe them for you so you know what we're looking at. For those looking on YouTube, you'll be able to see it. But we'll try to talk through a few different topics that we've been covering. So here, initially, I want to kind of talk about Bitcoin, or sorry, crypto in general. And this is just the screen on Bloomberg that shows the performance of the largest coins that Bloomberg covers, and you can
Right.
see particularly Bitcoin and Ethereum are at the biggest coins there are at the highs of basically at the highs of their 30-day range, right?
Correct.
We're just under 70,000. We got a well above 70,000 today in Bitcoin, in and around 37, 50 or so for Ethereum. Rumors of an Ethereum ETF yesterday. Tony, you're the crypto expert, so what do you think we have going on in the crypto markets these days?
Well, apparently, there are multiple reasons or drivers behind that. If we talk about the fundamental news that um, what could actually propel the skyrocket of the Ethereum's and Bitcoin's price over the past couple of days, and one of the major news is that the possible approval of the Ethereum's like ETF from the SEC is definitely one of the biggest news behind the movement of the crypto over the past 2 days, apparently. Now we have seen what had happened before when we actually talk about the Bitcoin ETF or Bitcoin spot rate ETF right at the beginning of this year, Rich, if you still recall. And most
Yep.
of the time, what happened was that most of the crypto assets actually rally before the approval of the SEC of the ETF, but it actually went down tumble um, dramatically. So we saw the buy on rumor and sell on news happen in the event of the Bitcoin ETFs, Bitcoin spot ETF. And it's very likely that we are going to see maybe the repetition of the Ethereum's ETF approval process. That what that means is people would actually investor would try to buy on rumor, and very likely that could be leading to another sell news like a scenario. And Ethereum is actually coming back up very strongly, but Bitcoin by itself is almost reaching to like a into year high. I think the Bitcoin the highest one is relatively about 72,000 with the news coming up the day before yesterday, and it
Yeah.
reached close by 71,000. This is actually giving us a very good expectation from investors, like enthusiasm perspective, that they really look for some kind of news to drive up the price of the Bitcoin. Apparently, as what we have discussed before, what had happened in year 2020 during the pandemic, we have seen like many of the meme coins actually skyrocket and pop up to 100% to even 10x when liquidity wasn't a problem at all. And
Yeah.
now this actually came back to the second driver that I actually bring up will be this retail investors' sentiments. And over the past 2 weeks, we also witnessed that many actually the meme stock actually pop suddenly just because of the news, either something like someone actually posts on Twitter, now X, about even irrelevant like a movie or movie video that the meme stock like GameStop, right? AMC's went back
Yeah.
up
Yeah.
100 or even 200%. So we definitely, from that point of view, we do see that retail investors are actually ready to almost are ready to jump into this kind of a maybe the late meme stock rally. This is typically indicated the market is at more of an aggressive mode, extremely aggressive mode, I should say. Now, it actually, from institutional investor point of view, could be a very cautious sign or red flag, or even at least yellow flag to institutional investor. Then the market right now is overheated about even minus or irrelevant news, which might or most likely might not be tied to the fundamental underlying the asset classes or security. So this should actually cause our attention. Rich.
Yeah, I would agree with you. I think when we talk about the meme stocks, we talk about the fact that we're back at or near all-time highs in a lot of the big parts of the market. And I think crypto, to me, is indicative of investor risk appetite, and we are certainly seeing that. The chart that I have up now, which I think really dictates, or really kind of shows to me what investor risk appetite is, not just in crypto, but in a lot of things, is this is the grayscale Ethereum um, product. And for a lot of people, that's their only access
Mm-hmm.
to the Ethereum market. I know that people can kind of go on either Coinbase or onto have their own sort of wallet and buy this, but for a lot of retail accounts, trading something on the stock exchange via their brokerage account is, or their IRAs or Roth IRAs or 401ks, is going to be what they can do. And Ethereum is the grayscale products are that. And we saw with the grayscale Bitcoin product, it was trading at a severe discount to NAV, because investors were preferring something else, and they were thinking that other firms were going to open ETFs. And what we saw that as when the ETFs were made approval, there were lots of flows out of the grayscale product, even though it's held on to money, but the money flowed out of that into other products where the costs were a lot lower. But we did see the discount to NAV collapse because they do ultimately own spot products, and it allows for the fungibility of that, and the discount collapses. And that went from 40% to 20% to zero over the 6 months or so when we were speculating the Bitcoin ETF. And what we saw here, I mean, if we go back to last summer, we see that the discount on the Ethereum grayscale product, the closed-end fund, was something close to 50, almost 60%,
Mm-hmm.
56%. And then after, in January, when it got as tight as about 8% when the Bitcoin ETF was launched, but then it widened back out to about 25%. And
Mm-hmm.
just yesterday and today, it's narrowed quite a bit to about 11%. So this to me is another clear sign that investor sentiment, and it's just, and when I see investor sentiment like that, and like you said, like in the meme stocks or in closing discounts on NAV on closed-end funds, et cetera, that just tells you got a lot of abundant liquidity. And while the Fed hasn't eased yet, there's still some expectations. It's not quite two cuts priced
Hmm.
into this year. We can debate whether we're going to get them or not, but I think what was maybe lost on a lot of people, including myself, I guess, is the fact that the Fed was really kind of backing off QT, taking it from 90 billion to about 25 billion a month,
Yes,
and that's really and they within that they're actually buying some treasuries too, because they're reinvesting some of those proceeds, and so there's a lot more liquidity being provided to the market, and we are definitely seeing that in some of the other assets. But I think in speaking of, assets that are certainly preferred, I won't say speculative, but ones where investors of all types prefer them. We've got tomorrow, we've got NVIDIA earnings, and NVIDIA, like we mentioned at the top, has become really, um, one of the major drivers of markets, and we can see that um, what's priced in terms of an implied 1 day move is close to 8% 1 day move,
yes,
priced into the market. And on average, we've had a little over 7% move. So it's not like it's necessarily an extreme move that's priced in, to the stock, but that's a pretty big move for a stock with trillions in market cap.
that's
And
correct.
so that's going to add a lot of, it's either going to add or subtract a lot of value to people's accounts around the world. And if you look at earnings, the average surprise has been something around 15% positive surprise, if we're looking over the last several years. And so the bar is pretty high for NVIDIA, but as we see, for the most part, with the exception of November 2022, NVIDIA has achieved, and beaten those high expectations and high bars. And so, while it looks like it's set up, NVIDIA the last several quarters, kind of going back to the summer of last year, the bar was really high, but they definitely delivered, and the stock responded in kind, and that's certainly led to the catalyst to to markets moving, to even new all-time highs, and we're at that point right now, right? If I look at the Nvidia chart that I'm bringing up now, 974 or so is the high. We're at 948. You see that we've bounced, we've kind of hit that level a couple times, early, this year, like in February March period. I think if we try that level and we kind of get through there, that could really, um, bring in a lot more new money that wants to buy that breakout. So this is going to be a pretty critical day for Nvidia, and for the markets overall. With surplus liquidity, one might think be leaning positive, but it's hard to say with expectations. So any strong views on Nvidia into earnings, Tony?
Yeah, uh, Rich, I agree with you that NVIDIA's earning tomorrow will be also a critical day for the markets overall. And as what we have been knowing that as a fact, like those kind of big tech name, including the Google, Meta, OpenAI, keep actually releasing lots of AI product recently. This is telling us that those big techs invest heavily into their capital. It's like we are going to see the huge capex most likely over the Q2's earning report. This is actually provide a solid foundation for the demand over for infrastructure and also other tech basics, the chips such as NVIDIA and other maybe storage like AMD or Marvel and even other endpoints, mobile end demand for Qualcomm's chip, etc. Now, most of the people, including both institutional investor and retail investor, academia, I think at this moment has no one actually doubt that generative AI is a revolutionary type of technology which actually could potentially disrupt the whole society, including the financial industry. And everyone is eyeing on this is one particular company, NVIDIA. This is no doubt. I think the investors globally, not just investors in the US, are watching this very closely. So you and I anticipated that if we actually go to the Google search and Google Trend to identify the index like about the NVIDIA, that half of them came from the US and half of them actually came from the emerging market, including the China and India and Taiwan, Japan and Korea. This is so you can see this is not just for one particular company. It's more of a, we can look at from more of a global event. And
Mhm.
many investors globally, right? They already purchase NVIDIA share either directly or indirectly through the ETF, or either directly purchase the NVIDIA share with their stock account. Now, with the high expectation, as we just mentioned, we definitely the investment community set a high bar for the NVIDIA's earning, but there was only one time that NVIDIA disappointed the market. That's what you point out very nice in year 2022. So from the statistical point of view, we do not see any reason that the NVIDIA will actually disappoint the market by delivering like a disappointment earning announcement this time, given all of the CapEx that we actually discussed and the CapEx from the big tech firm. However, the movement could potentially be a different story because any slowdown of their earning as growth, or maybe even they actually deliver some kind of a below market expectation guidance that could become detrimental for a lot of investors to pause and think that this is actually might be a slowing down of the capex from the big firm, or whether the generative AI might create lots of application that could potentially generate the revenue for many firms, right? Including the
Mhm.
AI PC that Dell in Microsoft they actually released yesterday. So here actually comes the things. We have most people have no doubt or have no difficulty, or even I don't have a difficulty that NVIDIA is going to report a strong earning. But most importantly is how they actually view the growth of the demand from the GPU chip and their products, especially that they actually announced the new one in last quarter, and how will actually fans out for the rest of the year. That's the guidance actually will play a very critical role in tomorrow's show. I actually kind of keen on as you, very cautious. I think there might be some movements around the earning announcement yesterday, but most likely I'm leaning toward a positive, like a minus positive sign, because on one end, the expectation is very high. On the other end, this is all of the fundamental support do actually support a strong earning announcement report tomorrow. But actually coming back again, now you actually mentioned a very great point. You emphasize a very great point. We do not see any liquidity issues over the market. There is abundance of liquidities out there, and any actually pullback over the market then could become a buying opportunity from retail and institutional investor points of view. So that's might be the worst case scenario. Even there was might be a pullback. There's a lot of people institutional investor would, with a lot of liquidity, would take it as a buying opportunity rather than they maybe a turning point for the AI play. This is how I think, Rich. What do you think?
Yeah, that's a fair point because I know as we know with high growth stocks, it only takes a slowing of those growth rates, oftentimes
Yeah,
for stocks to get to see a lot of downside. If you're growing at 30, 40, 50% and you ratchet down to 15 or 20%, that's still a really high growth rate, but that's not going to be enough to support your stock price. NVIDIA might be a little different because of this perception that it has such a first mover advantage on the
correct.
particular chips, maybe along more akin to and probably even on a larger scale than when Tesla had its advantage on electric vehicles. And even if it stumbled a little bit, investors were willing to give them the benefit of the doubt because they knew the competition was so far behind. I would say one thing that might be a little different, and I'm always cautious and nervous to say things are different, is that you highlight some really important things, Tony, is that the competitors that are going after NVIDIA right now are some of the most deep-pocketed investors and companies in the world, right?
Correct.
And all of the other Mag 7 names, global players, et cetera. So there's the competition is wealthy. It's coming in fast and furious, and so I think I don't have a strong view of NVIDIA. I'm just bringing up a chart right now that shows the NVIDIA earnings estimates graph versus the stock price, and what you see is every time we get this ratchet higher in earnings expectations, the stock does respond favorably. And when we get those expectations to move a little bit lower, the stock will fall. But you have seen if we kind of go back a little bit to the late 2021, the stock did get ahead of the expectations. So
Mm,
I don't have a strong view of what will happen on this, but I do think it will be critical for the market. And
I
one
see.
thing I wanted to bring up really quickly too is just kind of re-emphasizing to people that while we've had some stumbles in some of the Mag 7 names, and people have talked and joked about the fact that maybe it's now the Mag 5 or maybe even the Mag 3, the broader Mag 7 index, if people were invested in all of them, relative to the stocks outside the other 493 stocks in the S&P 500, um,
Yes.
the Mag 7's continued, even on a year-to-date basis, has continued to outperform materially, right? We know
Mm,
the S&P is up a little over 11% this year. The Mag 7's up over 20%. The excuse me, the S&P X the Mag 7 is up a little under 8%. And so it is definitely a handful of names that are driving the performance. Now, others are kind of moving along and because the economy is holding in there and liquidity is strong, but it is definitely the Mag 7 game that we are playing right now. And I think here's another chart that I'm bringing up, which is the S&P relative to the Russell. You see that S&P up over 11% this year on a year-to-date basis,
correct.
and the Russell, which has gone up very sharply in the last 6 weeks, perhaps. You know, if we look at the Russell going back to um, middle of April, Russell was negative for the year, and now it's up 3%. So it's had a very sharp rally in the last 6 weeks, 4 weeks really. But it is definitely these small cap names are still struggling and still lagging their larger tech brethren. So I think it'll be interesting to see if what happens, what the reaction is to the NVIDIA news, and if that leads to rotation within the market or if it leads to money flowing out of the market. And on that, I want to kind of bring up the relative rotation graph. We've looked at this before, and this is just at the sector level. We'll look at that first, but I think we can see that the tech sector, if you will, is definitely, excuse me, in that weakening category, broadly
Mm,
speaking. So I think there are some signs that um, that we're the leaders, if you will, the tech, the telecom, the industrials that have been leading for several weeks in the last month have started to fade, and we've seen things such as energy materials, but utilities has been on a really strong run as well. It
you
seems
bet.
that that there's been a bit of a rotation within the market. We talked about that going into earnings. Any thoughts on what you think of the rotation that we're seeing right now? And will that continue, Tony, or is this the kind of the maybe is this the opportunity for tech to kind of take leadership over again?
Well, this is a graph show a very interesting evolvement over the market over the past 4 weeks. Apparently, one thing, if we look at just at the top of the graph, it's like a utility. Now, utility has become very strong, and typically, when the utility become a very strong player, it actually cross the line that it shows that market could be showing some kind of a risk averse scenario, which they actually prepare for some kind of a recession happening. And material sector have been extraordinarily strong, but getting slightly weaker. What we have seen that industrial metal continue to show the strong momentums over the past 1 or 2 weeks, and including the copper, aluminum, and gold, right? All actually rally strongly against the market benchmark. Now, this is actually coming back to the point that we have been keep talking about, or the Federal Reserve keep focusing on, will be the inflation. Now, this time, this inflation is a commodity-driven inflation, in which actually tend to be resilient over the history of the stock market, and it won't go out or go away easily as what investor would anticipate, or what Federal Reserve might anticipate. Even though the past CPI reading, they actually show some promising sign that the inflation might be weakening. But from the consumer's point of view, we keep talking, Rich, and we talking about is that consumer are actually paying the end price. The end price has been reading to a very high point. So even though the CPI reading is getting low, which is actually just showing the percentage change, but the high point will actually slow down the consumer's spending, which would eventually actually slow down the revenue growth for most of the S&P 500 companies. And the S&P 500, S&P's index performance versus its a small cap benchmarks performance. This is also telling us a very interesting thing, that in the high interest rate environment, now small cap firms, smaller firms, tend not to have a stronger position within the market to actually to control or maintain the cost. Not like a large cap corporation, which can control their costs, the capex expenditures, like a very flexibly, by either actually showing the strong position over the buyer position. They have a more of a buyer powers against the supplier, and simultaneously they can actually cut the cost through many like cost management approach, including laying off people, which actually we don't want to see. So we can see the large cap firms have so much flexibility and capability to adapt to the high interest rate environment if the current monetary policy high for longer would last slightly longer than market anticipated. So this would actually will become beneficial to large cap, and most of the institutional capital has already realized this might be the case. So they continue to actually throw into the large cap firm rather than actually this smaller cap counterpart. This is explain most of the divergence between the large cap and small cap. And Rich, you and I actually are very pessimistic about the Federal Reserve's rate cut, right? We don't see any like a necessity for Federal Reserve to cut rate, given the current market liquidity. In this situation, now, what if actually Federal Reserve did cut a rate that actually might make the inflation even worse? And given the current situation, we will not see the Federal Reserve take a major reaction just in front ahead of the presidential election this year. This is too much of the risk for Federal Reserve to take. We continue to believe that still might be the case. And if that's the case, I think large cap would continue to dominate the plays over the smaller cap counterparts for the rest of the year. The recent rally, the small cap counterpart, was actually mainly driven by the perception that Federal Reserve might have to cut the interest rate from one cut to maybe to two cuts through the latest CPI reading. The odds right now has been raised from the one cut to relatively two cuts by the end of the year. Yeah, that's what you have shown here, right? But we have been telling, like, historically, market continued to be too over optimistic about the prospect of the rate cut from the Federal Reserve, in my opinion. So if that's the case, now, if that's the case, the small cap will continue to underperform the large cap stock. And from the investor perspective, this is like maybe having allocation toward large cap might be a slightly better odds sometimes, like from the earning stability point of view. It will show more of the smaller return volatility by holding the large cap stocks rather than the smaller cap counterparts.
Yeah, and so I just brought up the Fed expectations here from the market, looking at the Fed funds futures, and it's showing 1.7 cuts by December of this year, with the first full cut priced in November, only about 80% of a cut in September.
Yes.
Um, it has been bouncing around a little bit, but this is about where it settled in. Yeah, I think we both would agree that expecting a cut right around the election is probably unrealistic. Now, some would argue that that one cut, expectation of one cut might be interpreted as half the market thinks no cuts, half the market thinks two cuts by that point, that we might see some earlier than that.
Yeah.
I guess that's a possibility. But I think, to me, I think the market is focusing so much that we're going to have a soft landing with
Mhm.
growth gently slowing down, inflation slowly pulling back, and the Fed looking to cut rates. It's a possible scenario. We've talked about that before. That is a scenario, right? It's one
Mhm.
that the consensus, looking at the Bank of America Fund Manager Survey, more than
Correct.
56% of people are pricing that in. We see that in the performance of assets. That could very well happen, but the market has priced that in. Another scenario is a hard landing. Only about 11% of people think that there's going to be a hard landing. That's the recession. That's the very fringe part of the market. I don't necessarily think that we're calling for a recession. We're just saying that maybe things aren't as good as even the soft landing. Things could be a little bit worse than that. But that's not really priced in to assets right now. Another scenario which we've discussed is the no landing, right? Where
Mhm.
growth continues going along and inflation accelerates, and the Fed actually has to kind of come back and hike, and that's another possibility. And that's that's one where certainly some stocks could do well because growth would reaccelerate, but the Fed would solidly be in place. So that those that are generating earnings will certainly benefit. But kind of going back to that relative rotation graph, this kind of brings me to one of the themes that I've had in my Substack this past weekend, and in a lot of my posts on LinkedIn is the idea that maybe could we be seeing some stagflation? I know we talked about that.
Correct.
That Jay
Yes.
Powell doesn't think about that, but if you look at what's been doing well, what's in the leading category of global assets, it is commodities for sure. We see
Mhm.
oil, we see the metals are doing very, very well. We know that
Correct.
silver and gold are going to new all-time highs. But we talked about it last time. China has crept up into the leading category. And I
Yes.
think when we think of the commodities, we think of commodity inflation, I think investors are anchored on what was going on pre-financial crisis and into the financial crisis, where you wanted to buy everything China was buying and sell everything China was selling, because China had an insatiable appetite for commodities,
Correct.
driving those prices higher. But China was a disinflationary influence on all goods around the world because China was um, gaining market share as a manufacturing hub, and whatever China was producing and selling in global markets was keeping goods prices lower for consumers in the West. And so inflation was not a problem, even though commodities were going higher. And we saw that with the influence of like Amazon, for instance, in the United States, right?
Mhm.
Amazon, everything coming from China, driving the prices of everything lower. And I I guess what I would question, and what I kind of question today in my LinkedIn, is commodities could be going higher. China seems to be showing some signs of life, but is China going to be building a lot of construction in housing, condominiums, etc., or is China's growth really focused a little bit more on high-tech production and domestic consumption and not on the real estate boom? And so it's not clear to me that China is going to have some sort of export disinflation that's going to benefit the West, even though commodity prices are going higher. In fact, one of the drivers, I think, if we overlay um, China PMI versus other markets and the commodity price, it's actually India PMI. India, the fifth largest economy, is a fast growing. It's growing at 8 and change versus 5 and change for China. Its PMI is closer to 59 versus 50 for China. And we know we've talked about India several times. The best demographics in the world, right? Very
Mhm.
large, educated, and wealthy populace, and they import a lot of commodities, whether it be energy, I know China produces some of, or sorry, India produces some of its own energy, but it's importing a lot of energy. It's importing a lot of food, and so it's a big driver of commodity prices. But because it's not as massive of a goods exporter as China was, more of a services exporter,
Yes.
it's not clear to me that India is going to have that disinflationary influence on the rest of the world at the same time it's driving commodities prices higher. In fact, I would argue the fact that they're taking a lot of the white collar jobs, perhaps in machine learning, AI, et cetera, while buying up these commodities, India might actually be more of a stagflationary influence on the West, whereas China was a disinflationary influence on the West. And
Correct.
maybe that's a demographic theme that could be going through markets that while Jay Powell says he doesn't see stag or inflation, I think we might argue that you could see that. And, because we're seeing commodities moving into the leading quadrant, we're seeing bonds such as government bonds, the IAF, the TLT, or the Lehman aggregate, HYG, high yield, even the emerging market bonds, all moving in the lagging category. So something's going on where the market thinks that this commodity price movement is here to stay, and that's going to lead to higher rates. But I think we're also seeing some elements where maybe that growth, um, if we're seeing that growth, it's not going to be in such a way that's going to benefit the consumers in the West. It might be in a way that actually hurts the consumers in the West. And so that's something where I've been really looking at this a lot and focused on this and talking about this in all of my writings. And I think I don't think that's consensus views at all. I know it's not Jay Powell's view. What and we've talked about it a little bit, Tony, but what do we think about the possibility that India is a stagflationary influence on the global economy?
Richard, you comment on so many interesting points. Let me comment a little bit about the recent performance within the Chinese stock market as indicated of FXI, which actually consists of mainly the some largest the Chinese ADRs or Chinese companies with in the world. Now, there could be multiple reasons behind that. Over the past 1 year or two, we have keep hearing that the Chinese real estate market collapsed, and which actually can drag the Chinese economy, the second largest economy in the world, actually into a deep water, and we could potentially see the recession. And a lot of investors anticipated that the recession might be going on in China. But the recent stabilization, given the Chinese government's like recently both physical, I think physical and monetary stimulus, as what we have seen in the U.S. back to year 2008, the recent policy or stimulus from the Chinese central bank and Chinese government actually had done to a very great extent to stabilize the real estate market. And this is, could be a revival perception that the Chinese real estate market could just stabilize here and potentially to rebound. And the worst scenario had been priced in the past. So any marginal change or improvement about the Chinese real estate market and can potentially, you can anticipate it, can drive up the risk marginal return over some small percentage of risk into that kind of investments. That means the risk reward for investing into the Chinese stock or Chinese market stock market at this moment could be even higher than investing into many developing countries, including the Indian and Japanese stock market over there. Both of them have retraced slightly from the all-time high. So this is one of the reasons that we can explain to the recent strong performance of FXI or the recent Chinese stock market. And many hedge funds that I had spoken with in the U.S. has got some exposure over the FXI or directly investment into the Chinese stock market, like Baba, acquiring their stock directly. So from their point of view, they do actually see the marginal improvement of those kind of companies fundamental given the current situation. As we all know, the conflict or tension between China and the U.S. was one of the reasons that actually that caused the like I would say the cautious investors like hesitation or has make the investor hesitate to invest into the Chinese ADR in the US or Chinese stock based on some kind of a maybe political risk or political tension. And especially many of the what we call the ESG funds do actually cut off their exposure to China, even though they still continue to maintain like a ESG exposure to the emerging market, but they continue to actually cut off the exposure to Chinese stock or Chinese stock market. So that was the reason that I think from the valuation point of view, Chinese stock market was actually quite low compared to the other counterparts in the world, Indian and Japan, even Taiwan. So from that risk and reward perspective, I think that already attract many risk-seeking hedge fund into investing into the Chinese stock market. And any minor change can actually make the performance like will be very attractive. So that's one reason. And second reason, even the China, as what you're saying, they typically consume the commodity because they used to be the manufacturer of the world, continue to export the product, electronics, to the rest of the world. But they are actually making some kind of a strategic move from the manufacturer of the world to more of a high growth, high quality exporter based on some new technology, including the AI and semiconductor and electronic vehicle. That's the Chinese, I think the Chinese government's strategic initiatives happening over there. And the Chinese government and the US government have been engaged into some kind of a strategic discussion over how the two countries either how to actually manage the conflict or competition and simultaneously trying to create the beneficial scenario for both countries and for the rest of the world. So hopefully looking forward to some kind of policy development over there. And now let's actually talk about India. India is quite different from the China. In India, apparently beneficial from what we call the deglobalization process, during which many of large international corporations actually moved their manufacturing out from China and into India. And India apparently took a big bite. But because of what we have known that the lack of the infrastructure in India could be a reason for relatively low productivity, as what we have seen in China, which actually might actually take a long time to continue to grow. Just simultaneously, the sudden inflow of the capital and creativity of many like a job opening in India that will also create the inflation in India over there. And because India, we all know that they actually do not have too much of the natural resource as maybe other countries like Russia or China or even Australia. Now, India actually might have to import it, might have to absorb the high price of most of the commodity, including our energy, aluminum, in those industrial metal that we haven't seen. So this will continue to actually drive up the inflation in India. Stagflation is very likely happening over there. This is what we definitely can tell. Now the inflation over there in India is roughly about 6.5% on an annual basis, right? Roughly, it's like compared to even 3%, 3.7% here. Here we already cannot afford it. The consumer cannot afford it. But you think about the inflation back in India is so high. So the high growth and simultaneous coupled with the high inflation might be more likely to slow down the growth of the Indian industrial growth over the next couple of years. That's my take on this, Rich. But I do actually agree with you that the scenarios are very different from the China and very dramatically from the India. And if we look at the U.S. from the U.S. point of view, this will be a very interesting interplay among those kind of major major economy in the world.
Yeah, for sure. And I just in kind of wrapping it up, I just wanted to show. I was looking at it while you were talking the one thing that we have to understand. I mean, we've talked about how a lot of maybe global managers wanted to with all the crackdown and corruption in China had kind
Yeah,
of pulled out and found China to be thought that China was maybe uninvestable. Um, However, global managers, especially those who track an MSCI benchmark, an MSCI emerging markets benchmark, China's a big part of that benchmark, right? And I was just bringing up the
yeah,
holdings in the MSCI emerging markets index, and you can see, I mean, sure, Taiwan Semi and Samsung are at top of the stack there. So is Reliance Industries in India,
all right.
but you have Tencent, you have Alibaba, you have Pinduoduo, Meituan, China Construction Bank. Further down, you see the Bank of China down there. You see JD.com.
Yes,
There's quite a few, whether they be listed in Hong Kong or for the most part because of the access, but there's quite a few names in China and Hong Kong, Chinese mainland companies that are definitely listed in China, and that's a big part of the index and something that a lot of investors have to focus on. And
all
like
right.
you said, the China that we're seeing, the Chinese economy that we're seeing right now, is transitioning to a different Chinese economy than what we were used to in the
Mhm.
kind of the 2005 to 2010 or 12 period. As it's grown, it's maturing. The population is starting to age, and the government's focusing on a lot
Yes,
more domestic consumption. So the drivers are going to be probably a little bit different. And as investors, we have to step back and focus on that.
all
So
right.
we're probably a bit out of time here, Tony. I just wanted to see. I know we will be probably a couple weeks with the holidays before we kind of get back. And any other last thoughts? And I think it's all about NVIDIA, all about what that means for. Is there going to be a breakout in tech, a breakout in Mag 7, or will we see a rotation within the markets? Or could the news be so bad that I doubt it, but could the news be so bad that it signals a top in the markets? But is this going to be a catalyst for rotation into other assets, for instance, emerging markets or small caps? Or is this going to be the catalyst for the Magnificent Seven to take us to new all-time highs?
Well, from my point of view, that historically speaking, we do not see too much of liquidity, relatively low liquidity in the summer because like investors actually do actually go outdoor and then spend the time on vacation together with their family. And this year without the concern of pandemic, and I would anticipate that this might still be the case that as of maybe you and I will both maybe spend some time on vacation. I mean, a lot of investors are planning this and doing so. So given that's the scenarios, like even the NVIDIA's give this worst case scenario, give disappointing guidance or below expectation guidance tomorrow, what I would tend to say the market will actually more of us will stabilize quickly out from that, and we probably might not see too much of a movement like before we come back from the vacation or in the summer. So that might be the time that we can spend more time. And one more thing, okay, the over the past couple of weeks, we already finished most of the earning announcement report for the. We will finish the earning announcement report for the company S&P company in 1 week or two. So given the current situation, I think the many analysts already upgrade their earning expectation for many firms. So given that's the situation, the fundamental remain very strong for many of the large cap firm and in S&P 500 or Russell 1000 or Russell 1000 growth. So with all the strong fundamental given forward, we might continue to, I actually would stay positive over the U.S. stock market for the rest of the year.
Oh, that's a big change. They're breaking news here.
Yeah.
You're getting a little more positive. You're right. That would be interesting. It'll be interesting to see. Well, we'll catch up before everyone kind of goes into full vacation mode and see what's going on. But Tony, thanks again for joining me. And for the listeners out there, please remember to like, share, and subscribe as you know what to do on podcasts and any sort of social media. It always helps us to kind of understand and broaden our reach. Thanks everyone for joining us on the latest edition of Macro Matters, and we'll see you again in another few weeks.
Yeah,
Thank you.
thank you, Rich. And hopefully we'll come back quickly to actually wrap up what will have happened right after the earning announcement of the NVIDIA tomorrow.
Sounds good. Looking forward to it.
Yeah, me too.